welcome to this brand new episode of Investors Guide. Thank you so much for tuning in. I'm Faye D'Souza. Get a pen and paper and take down the advice you hear over the next half hour, because this is what we're going to be doing. We'll start off by taking a look at the multi-cap mutual funds that we have recommended for this year, and we'll find out how each of them are doing. We'll also look at the Access Equity Fund, and we'll tell you if you should be panicking at all given what's happening in the stock market. Let me begin with Virendra Kumar. Virendra, thank you so much for joining us on the show, and it's a very important conversation that we must have. We know that the Indian markets and a lot of investors are nervous about what's happening on the border with Pakistan. We've had mixed messages come in from several analysts. Some have told us that there's nothing to worry about. Others say that you should have about 20-25% in cash, because this sort of thing might continue for a while, and this market tends to react to this kind of nervousness, as we saw it happen on the 29th of September. What's your advice then for long-term retail investors or putting money in mutual funds? Should they be reacting to this news or this information at all?
When we are talking of equity or fixed income, your choice is clear, and war or no war, it doesn't matter, because good businesses will do well. That is what we are. That is why we invest in equity. And war or warmongering or fears of war has been very much a part of our investment framework last 20-25 years. And yes, it worries us. It causes anxiety, but you can do nothing about it, and you should not do anything about it.
The advice said for retail investors like us is to not panic and to just continue our SIPs. Should it then also, should we draw the same conclusion that when we hear people or we hear analysts give advice on television shows, they're giving advice to traders and not to investors, and investors should be very clear about the kind of advice they want to take? Teresa?
Absolutely. This is something where, in fact, this will turn out to be an advantage for Indian investors who follow our advice in terms of staying invested, continuing their investment, because the short-term outlook definitely becomes grim. There's a great deal of anxiety, and FIIs are a major player in the Indian market, and they getting worried or they actually putting brakes on their investment even for a few days has an impact on the market, and that causes volatility, that causes a decline, that causes a market fall in a brief period of time. And that is the time, in fact, if you look at many of the investors' return by way of their SIP as compared to a point-to-point return in a fund over a period of time, I think most investors greatly benefit by this volatility.
Stick to your plan. Don't get distracted. It will enhance your returns. And if you have any questions, that's what we're here for. We've been here for the last 7 years. You should just write to us if you're feeling nervous about anything that's going on in the stock market. It's time for us to take a look at our multi-cap funds for 2016. Now, these were funds that were recommended in the beginning of the year. I want to just revisit them at this point to see if those reasons that they were picked still hold. The Mirae Asset India Opportunities is the first one on that list. Also, there's the Franklin India Prima Plus, the iProve Value Discovery. These are the three funds that you picked. Mirae Asset India Opportunities is a 4-star fund now on value research. Would you say it still holds the same reasons? Is it still your top pick for the year?
Yes, it remains a top pick, and it remains, I would say that a marginal decline on a relative basis can lead a fund, can make a fund slip from a 5-star to 4-star, though this is a large category. So I don't think it is a cause of worry at all on this front.
ICICI Prudential Value Discovery has also been a fund that has been recommended on this show quite often. It's coming in at number 3 among your top picks for 2016. Does it remain that fund for aggressive investors? If I wanted to have only one fund in the market, could this be it?
It remains a good fund. It continues its the impressive returns are still visible. But I think one should get watchful about this fund as it gets bigger.
Also, the Franklin India Prima Plus fund, it's still a 5-star fund of value research. This was the second fund that you recommended for 2016. Does it still come in at number 2 for you for the year?
Yes, it comes in at number 2, and it remains a very attractive fund. Its long-term track record, of course, in recent times, years, I have been thinking in terms of whether this fund should be substituted by the High Growth Companies Fund, which looks like a better performer and more focused. But I think what this fund has demonstrated over a period of time, and without its high growth orientation, that it will always be the very desirable kind of multi-cap fund. It is not facing any headwind on account of its scale. So this continues to be a good fund and remains one.
continues to be a good fund, and it remains one. I'll give you a recap of the funds. These are multi-cap funds that were recommended for 2016. They remain on our list. The Mirae Asset India Opportunities, Franklin India Prima Plus, and the ICICI Prudential Discovery Fund. Remember, if you are an active investor, you can go online and do your own investments. Then using the direct option will increase your returns over the long term. Then let's move on to our portfolio profile. This week we have a 30-year-old with 2 dependents who wants to focus on his child's education. Hari Krishna S. has written in from Kerala. He says that he has a 2-month-old daughter and he wants to build a corpus of 35 lakh rupees for her education over 15 years. He's ready to take on a certain amount of risk. 75 lakh rupees might be inadequate over 15 years, but that's a separate conversation. He sent us a list of all of his investments, but I first want to focus on the fact that he has 12 funds, some of which he got in on a lump sum. So over a 15-year horizon, I just want to focus on the fact that 12 funds, however well picked, are too many for any one investor.
Yes, absolutely. And there is the biggest problem of such a diversified portfolio is that it might tend to be his aggregate return will be that of an index fund because you diversify so much. Because if you look at the average, even taking into account the overlap in fund portfolio, if you have 2 funds and 60% of the fund portfolio is common, despite that, having 12 funds of different kind, you will end up with the underlying portfolio might be of 350 to 400 stocks, which will make it almost like a BSE 500 return with such a high expense. And the other psychological problem that an investor faces with such a fund is that with such a portfolio is that when your fund is not doing well, then you are not interested because you think that it's a small part of it and time will take care of it, which it does. But that's not a right way of approaching it. I think he should just map to one of our portfolios, our aggressive growth portfolio or our growth portfolio, and that will do the job. He will only have 4 or 5 funds. We will also be periodical. We review it periodically. We suggest the changes, and he will be interested because a meaningful position in a fund will keep him interested in each and every holding that he has.
Let's take a look at his other financial details. He has the National Savings Certificate, 75,000 rupees, 3 lakh rupees in bank fixed deposits, an LIC sum assured of 8 lakh rupees that will mature, he tells us, in 2030. It's a 20-year policy. He has a PPF of 25,000. He has health insurance for 4 lakh rupees, IDBI Federal Life Insurance. He tells us he's not giving us a value of how much, and 7 lakh rupees in shares, along with a 9,000 rupee SIP that is just going into the various funds that we talked about. A lot of the money seems spread across inefficient investments. I'm talking about the NSE, the PPF, the LIC, the life insurance, which I'm fairly sure is not a term insurance policy. Is there any way he can consolidate all of that, move it all into something that will work well for him?
Yes, it will definitely work well for him. In fact, he should have a larger emergency fund in terms of a deposit and something lying in his bank account. And it could also be little more than what he already has in terms of 3 lakh rupees deposit. He can do without the PPF, and if the way he's approaching his SIPs. I think his long-term allocation should be in equity, but it's a very hard thing to do. We have been suggesting investors not to consider a PPF for the long term, and recently I got a taste of the apprehension or the kind of belief people have in PPF. Undoubtedly, PPF is you get the guaranteed return. There is absolutely no concern about the safety of your principal, but that's not the point. PPF is a long-term, recurring deposit, and you get the tax benefit. This can be derived from a mutual fund, either with for your first 1.5 lakh rupees per annum annual investment in a tax saving fund, and it will get you exactly the same benefit and substantially longer return with almost a negligible risk, simply because when you think of equity and periodic equity investment for 15 years time frame, I haven't come across any situation, the worst of situations, in any 15-year time period. If you invested at the worst of times and pulled your money out at the worst of times, you will still be much better off than what you derive in terms of return from PPS.
Let me play devil's advocate here, and I'll tell you normally what is the response that people give when you tell them not to buy gold or not to buy into long-term debt investments like the PPF or fixed deposits. Their whole point is over a long term, when we're talking about things like our own retirement, there is a certain amount of money that needs to be entirely risk-free. And risk-free would then mean putting money into a fixed income or into gold. What's your rebut to that argument that I would like the comfort of knowing that a certain amount of money is entirely risk-free in terms of both capital and returns?
No, I think, if it is planned methodically, and it can be planned with great simplicity, if you have taken a life insurance, if you have taken a health insurance, and if you have an emergency fund and you are still earning, you are well taken care of. Only when you get into retirement, when you have to derive income in retirement, after you have retired, your income has stopped, that is the time when you should have a larger allocation to fixed income. And there also you should have a formula. The formula should be, a very conservative formula should be that 5 years need for monthly income, assuming that you are going to spend 25,000 rupees a month, or that is your monthly personal requirement. Then you need 3 lakh rupees in a year's time, and then you should put 15 lakh rupees in a deposit and withdraw your money from there, or put that money in a fixed income fund. That money should be in fixed income. You are free from anxiety. You don't have to worry about next 5 years. And remaining money must be in equity, simply because if it is not in equity, it will not be able to beat inflation, and then you run the risk of outliving your savings.
All right, we're going to take a quick break, but before we take that break, here's a recap of the important things we picked up in this segment. First of all, don't get worried about what's happening on the border. If you are a long-term investor doing an SIP, just continue to do your SIP and remain disciplined. Secondly, if you're investing for something that's 15, 20 years away, like we've seen in this particular case of Hari Krishnan, what you need to do is, of course, not rely so much on things like PPF and fixed deposits, because they will actually work against you in the long term. You should be investing in equity. The fear of inflation is really the biggest fear we need to have as long-term investors. This week in our product review, we look at the Access Equity Fund. Aman, you give us the numbers first, Aman.
Thanks, Faye. This week, we take a look at the Access Equity Fund. Launched in the year 2010, this fund did reasonably well during the time of its launch. But how does its performance look in the short term? The red line is the fund, and the blue line is its benchmark. You see that the fund has barely outperformed its benchmark in the last 5 years. While the fund gave an average return at the time of its launch, the last couple of years have not been very impressive for the fund. In the year 2015, the fund's performance dropped to a negative 1%, way below its category and its peers. In fact, you'll also see that the fund's performance has dropped drastically when compared to its peers, both in the short and the long term. The fund's return was just 10% in the last 1 year, putting it at the bottom of the pack in a rising market. Is it time for you to sell this fund? Let's find out. With that, it's back to you, Faye.
All right, Aman, thank you for those numbers. We're getting a lot of emails from very worried customers of the Access Equity Fund. It's down to 2 stars on Value Research, and I assume that that's the reason why a lot of the customers are so concerned. It was a very promising fund when it launched. It hasn't been around for a very long time. What is happening? What is going wrong with this fund? Why has it fallen down to 2 stars?
This fund just lost its momentum after its initial 3 years. It has delivered lower returns relative to other funds. Of course, it has beaten its benchmark, except for very recent time, 6-8 months, year to date. It has beaten its benchmark, and and its benchmark is also a large cap Nifty 50. So Nifty being its benchmark, it has beaten its benchmark. But the other option that we have, and it's a conservative approach of late, that it moved to it got large cap tilted ahead of others, anticipating a not so great market, getting conservative early ahead of others. That I think has taken its toll. So one has to wait. I don't think it turns out to be a good choice at this point. And if you are invested, one should definitely consider selling it.
Consider selling out of this fund, Virendra, and moving to what is the alternative now?
No, in earlier part of the program, we talked about our multi-cap selection, and they are definitely a superior bet. In last 2-3 years, they would have rewarded investors substantially more, as compared to Access Equity.
Whereas on your screen right now are the 3 multi-cap funds that we recommended at the beginning of the show. You can use any of the 3 as an alternative to access equity if this is the fund that you're in right now. Virendra, it's 2 stars on value research. What is the star rating for investors, guys?
Same as the risk-adjusted scale. It's a 2-star fund, and very disappointing that the phase of the life of the the initial phase of the fund, when it was not rated, it was an outstanding fund, and ever since we got the indication that it is going to be right or it is going to be an impressive choice, it has been disappointing.
It has been disappointing. 2 stars there for the Access Equity Fund on Investor Guide. If you have any questions about that review, feel free to get in touch with us. Let's move on to our buy a home segment. Vijayanand Naidu has written in. He says he wants to build a corpus or to buy a home for his children's future and his own retirement. But his first goal is to buy a home. He wants to save about 80 lakh to 1 crore rupees for a home he wants to purchase in 3 to 5 years, factoring inflation. He says he's taking a home loan for a period of about 20 years. So he'll need 20 to 40% of the corpus in down payment and 60% to pay off his home loan in 8 to 12 years. He's invested 43,000 rupees in mutual funds so far. He sent us that long list. But I want to first consider his question there before we get into his mutual funds. The fact that he wants to take a home loan and, like most Indians, pay it off as quickly as possible. So it defeats the entire purpose, because now what he wants to do is he wants to save 1 crore rupees so that he can pay off a home loan that he hasn't taken yet. Is there a different, more more logical way he can approach this entire thing?
It's not a bad idea to be accumulating your savings, or investing in the market to make your down payment. And after that, I don't think it's wise to be thinking in terms of prepaying your home loan, simply because we are generally risk averse and we don't want to be we don't want to be carrying a debt. But I don't think it's a bad idea. This is the only kind of debt which you should carry, because on any 10 or 15-year time period, the interest cost that you'll incur on a home loan is bound to be lower than the equity return if you're a regular periodic investor. So if your budget permits, if you continue investing, and that is accumulating into something sizable, and over and above that, if you can pay your EMI, do that. Don't try and prepay your home loans, simply because your investment accumulation will be earning higher return, and that can well turn out to be your retirement corpus or something more sizable. And so it doesn't make sense to be prepaying your home loan.
It doesn't make sense to prepay your home loan. In fact, let's take a look at the funds that he's investing in. He has Access Long-Term Equity, Birla Sun Life MNC, Birla Sun Life Next Generation, SBI Blue Chip, Franklin India Higher Growth Companies, Canva Robeco, the BNP Paribas Dividend, and the L&T Value. I think there are one too many funds in this portfolio. He wants to stay invested for 20 to 25 years for his goals. So the first piece of advice is don't attempt to pay off your home loan as soon as possible. In fact, and this is for all investors, when you have extra money in your portfolio, invest it in equity. It will do better than what you're paying on your home loan right now in terms of interest. In his mutual funds, do you want to just give him one of our portfolios? Will that serve him better?
Yes, absolutely. The kind of investment time frame that he has, he should pick one of our portfolio, plus he should retain his Access Long-Term Equity, the ELSS fund, or he should definitely allocate that 1.5 lakh rupees or 1.2 lakh rupees, which is investing right now in a tax saving fund. Beyond that, he should consider one of our, for the remaining 30,000 rupees investing in mutual funds. He should consider one of our portfolio, and that will be more manageable. He will be interested in that portfolio, because, in each and every investment, because at most he will have 4 or 5 funds, and that should turn out to be that is likely to provide him more, superior diversification and hopefully superior return.
Superior diversification and superior returns. But the big takeaway is don't attempt to constantly, and I know as Indians, we have this need to pay off all our loans as quickly as possible because we see it as such a massive negative. But a home loan is not a massive negative because it gives you a huge tax deduction, which you don't get from anything else over and above all of your investments. And right now, we're in a lowering interest rate regime, which means that your interest on your home loan will keep coming down. Those are factors to keep in mind. Reza, one last question, and this is such an interesting one. 23-year-old A.D. Reggie writes in, he's going to complete his graduation in medicine, so congratulations to him. He has no liabilities. He wants to invest for 10 years, and he started to use our aggressive growth portfolio. Now, here's his question. he is worried about the fact that several analysts have been saying that the market right now is overvalued. And he's talking about the PE of the market of the Sensex and the PE of the mid-caps at this point. He wants to know, does it make sense to alter the portfolio, move into the balanced portfolio, because analysts feel the markets are overvalued at this time, and they don't see at this current PE ratio, they don't see it actually moving up any further. What advice would you give him?
If you try and get into the balanced portfolio, you will benefit, but it makes it very imperative that you move from the balanced portfolio to the aggressive portfolio at the opportune time. And I think not even fund managers are geared to do that. In fact, I come across a lot of multi-cap managers who are unable to position themselves. In this program itself, we were talking about Axis Equity. This fund did very well till the market was struggling, and ever since the market started going up, this fund has not been able to catch up with the peers. So I would say that things change in the market. Many fund managers are unable to cope with that change. It's extremely difficult for individual investors to do this tactical, shift or changing track. Don't do that. You will miss out on the big opportunity while trying to be tactically right. And generally, you will. Many of the big moves actually happen when you least expect it, and more so when there is a consensus view, it generally doesn't materialize in a expected time frame, and that spoils the whole year, and it could be a test of patience. Don't do that. Implement a simple plan. 10-year time period is something where you will not be disappointed. Anyway, you are getting started, you don't have much of your money, which will decline in value. Most of your money is going to be invested over a period of time. Do simple thing. Invest regularly. Increase your income as your income rises. Invest only your long-term money into your aggressive portfolio, and if you succeed with your practice, you will have substantially higher accumulation over 10 next 10 years.
All right, so here's what we've learned in this short segment. There's a sell call now on the Axis Equity Fund. You'd be better off in investing in one of our multi-cap funds that were picked for the year. That's going to pop up on your screen. There it is. Also, if you're a long-term investor, don't attempt to pay off your home loan with any spare cash that you have. Invest that money instead, especially given the market that we are in right now in terms of a lowering interest rate regime. And finally, Dhirendra is saying that, while you're investing in our portfolios, if you're using any of our advice, don't make tactical strategic moves and try and outsmart the market with this advice. At least this is advice for long-term retail investors and not for traders. That's a wrap on Investors Guide. Dhirendra, thank you so much for joining us on the show and answering all of our questions. It's a pleasure as always to chat with you. Our email ID is available. My Twitter account is on your screen. Feel free to get in touch if you have any questions. Thanks for watching.